It's Thursday, July 2nd, and stocks are selling off with tech leading the charge downward. The NASDAQ is down 1.2%. Is it time to rotate out of tech completely? Or should we be looking at only the innovators and disruptors who are still the leaders in the tech space today? It's not what you think. Our next guest is going to reveal his top tech plays, his top investment theses for the year, and we're going to go over his outlook for Fed policy and his analysis of what the latest jobs numbers mean for the economy and for your investments. So just as a point of reference, today on Thursday, the employment numbers came out. Non-farm payrolls for June increased by only 57,000, which was much lower than the expected 115,000 jobs expected by the Wall Street consensus. So what does a much weaker than expected print mean for Fed policy and the economy? We're going to find out. Sam Rahman joins us now. He is a portfolio manager at Hedgeye Asset Management. This video is sponsored by Kalshi. It's the largest prediction market in the US. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started and use my code LIN, L-A-N. When you use my code, new traders can get $10 when you trade $10. Right now, traders are predicting whether or not the NASDAQ 100 will finish positive this year, and there's a 79.5% chance as of the time of this particular recording that it will end positive. So we're going to get Sam's take on whether or not the NASDAQ will go up or down or sideways, and his take on this particular trade. If you do place $50 in this trade and you're right, your payout could be $62 or more, depending on the probability of the time. Sam, welcome to the show. Good to see you.
Hey, David, how are you?
I'm doing quite well. Markets are doing quite well today. We're speaking on the 2nd of July. Actually, no, they're not doing quite well. That was yesterday. 1.5% down. The NASDAQ is 1.5% down. The S&P is about 64 basis points down. Gold is having a pretty good day, up 1%, and Bitcoin's having a pretty good day, up 2.5% as well. And over the course of the last couple of days, I've noticed a divergence between stocks and precious metals and other risk-off assets. Now, this could just be profit-taking on the part of investors in stocks and rotating into things that have fallen a lot, but it could be the start of a bigger rotation away from tech stocks into undervalued assets. Is that what's happening right now, Sam? How do you interpret current market action?
Yeah, I think right now what you're seeing is a bit of an unwind. So positioning-wise, a lot of people were very overweight semiconductors and related stocks related to the AI theme. I think the last couple of days you're starting to see that unwind, and this is kind of accelerating today. I mean, it's not helping that you have a 3-day weekend ahead of you. On the other side of it, the beneficiaries are everything that is not AI. So, healthcare stocks are up, consumer staple stocks are up, financial stocks are up. So basically, money's moving out of tech to everything else. And these sort of moments can happen very quickly. They're short, they're very painful, and I think that's kind of what we're seeing right now.
Okay. Are the tech companies still led primarily by the Mag 7? If we were to, let's say, invest in the tech sector, which is a big component or a major component of the S&P now, and I were to have to pick between the winners and the laggards, are the winners still the Mag 7?
No, actually, ironically, the Mag 7 has been, year to date, being the losers within tech. I mean, the winners by a long stretch have been semiconductor stocks, memory stocks that are like key critical components of the build out of data centers. They have been by far and away the biggest outperformers this year, and stocks like Micron and SanDisk and Applied Materials have been massive contributors to the year-to-date performance of the index. So, if you look at the Mag 7 stocks, there probably aren't many that are actually up year-to-date. Most of them are down.
So in a sense, the Mag 7 have shifted from being, I guess, the innovators to perhaps the, I don't want to call them the laggards of the space, but the lower growth aspect of the tech sector. Is that fair to assume?
Yeah, another way you can phrase it is like they were disruptors.
Yeah.
When they came along 10 plus years ago, they were the disruptors. Now with AI, The question is, are they the disrupted? And that's kind of like what, I recently talked about in a thought piece I wrote a couple of months ago. But I think really to be fair, the market decided several months ago that the hyperscalers, which are some of the Mag 7, were spending massive amounts of money to fund this AI build out. And so they sold the spenders and they bought the beneficiaries of that spend, which has been semiconductors and memory stocks. So that's kind of what the trade has been year to date. And the question is now, has it stretched a little bit too far?
But the semi stocks are now dependent on the Mag 7 because they're the biggest customers in many cases. So take a look at this news that came out today. So the Kospi index fell to the 7,600 level today, and it plunged about 7.89% on the day so far. Now, as you're probably aware, the Korean Kospi index was the number one performing index year to date in the world as of June. Now, amid a shock triggered by Meta, it seems, Meta's move into the cloud business cooled semiconductor investor sentiment in the U.S., and sell orders poured in around chip stocks in Korea as well. In particular, foreign investors net sold more than 5 trillion won on the Kospi that day, dragging the index lower. Meta announced that it would focus more on, well, not focus more, but move into the cloud computing space, potentially decreasing demand for semiconductors. Can you just comment on, first of all, the dependence on semiconductor stocks on Mag 7 stocks, and secondly, the transition that Meta is announcing today and what that means for the overall tech sector?
Yes, certainly. So semiconductors, things like memory, GPUs, and CPUs are a large percentage of the bill of materials. If you build a data center, you have the shell, you have the power, and the support functions around it. But a big part of the spend are the chips and the network equipment that go into the racks that go in the data center. So, so they're very obviously, this is a Capex boom. So Capex drives the spending in those critical components. This is going to be a long-term boom, but the stocks have clearly, gone up a lot. And so what you're saying right now is a little bit of digestion. I don't think the Capex, to be honest with you, is going to slow down anytime soon. This year or next year. As it relates to Meta, I think the Meta news was more of an excuse than a real reason for the big sell-off in Korea and the tech stocks here today.
Yeah.
To be honest with you, we can talk about Meta in detail, but Meta is a company that is in search of a strategy. And the question I have when I thought about this company is Meta the next Oracle?
That's a very good point. It started off being the number one disruptor in social media, and then it rebranded into Meta because they wanted to move into the metaverse. What happened there, by the way? Did they ever make that transition fully? And now they're trying to shift gears into something else. Yeah, go ahead.
Yeah, they pulled the plug on the metaverse because they realized they were losing too much money. The stock got absolutely destroyed in 2022. And shareholders were screaming at them to tell them, look, you gotta get with the program. This is a money loser. I mean, so they switched gears, they cut expenses, the stock rallied substantially, and now Zuckerberg is in search of another unicorn to chase after, which is AI. This guy hasn't innovated anything since the original Facebook. He's bought everything since then. With Instagram, WhatsApp, and now in terms of a strategy course correction, he's latching on to building an LLM and building out meta compute to compete with, the behemoths in the space. The reality is that Meta is facing an existential risk, and that existential risk is AI. Because if you and I in the future are going to spend more time with our AI agent or AI agents on our phones. And we're going to be talking to them and booking flights and travel and restaurants, and they're going to be organizing our days. That's less time on social media. So engagement is a massive factor that drives Meta's business. And if they start to lose that at the margin, that's a big problem for their advertising business at the margin.
Do you
So
still
the
use
reason why
Facebook
they're chasing
yourself?
after AI is they're realizing that that is a risk that they have to mitigate.
Do you still use Facebook yourself, Sam?
No, I haven't used it in years.
Yeah. So maybe Meta and perhaps other big tech companies become more like venture capitalists in their model, acquiring things like WhatsApp and Instagram, and that is their core business model, acquiring and developing and marketing winners and actual innovators in the space. What do you think?
That's a really good point. I think several years ago they were doing that, and they're doing that very, very successfully. Not just Meta, but Google,
Hmm.
Amazon. You go down the list, they were all being very smart at picking up sort of new companies that were coming along. What stopped that was the DOJ and the FTC decided that we're not going to let these companies get too big. And so some of these acquisitions or pending deals that they were trying to do were blocked. And some of them, for example, Meta was dealing with, I can't remember if it's the FTC or the DOJ. They were fighting with them with regards to going all the way back to the Instagram acquisition. The government wanted to unwind that. So Meta eventually won the case because you can't go back in time and unwind the deal. But I think that that game is over for the big mega cap tech companies. I think the bigger thing right now that they're facing is AI in various degrees, could be viewed as a threat for some of these companies. And I think Meta is particularly vulnerable because of the fact that if you look at I think the three things that matter for these big companies is, do they control the compute? Do they control the app layer or the user interface? And do they have control over distribution? Because any successful tech company going back 30, 40 years, you could see those three things as commonalities.
Yeah.
Meta has compute, but not as much as the other guys. And it's really mostly for internal use. They don't really control, they have the UI in terms of the apps, but the underlying platform is owned by other companies. And distribution, which is where the apps are based off of, like the phones and devices, are also owned by other companies. So it's not a good spot to be in relative to the other competitors that they're dealing with.
So prediction markets, this one's from Kaushi. Our traders are predicting that there's a slightly greater than 50% chance that the NASDAQ 100 will finish positive this year. Right now it's at 63%. So currently at 29, and this trade turns yes into yes if it ends above 25,000 points or above. Now, if you take a look at the NASDAQ 100 chart, it's up about 13% year to date. There has been some consolidation ever since mid-May.
Yeah.
One could argue the momentum has stalled for the last 6 weeks rather. So for now, it's going just chopping along in a sideways pattern. What has stalled this momentum, you think?
I think a big part of it is just, I think people are just trying to, people are rethinking this whole massive Capex boom,
Hmm.
and whether there's longevity to it and whether it's too stretched. Like I said, the hyperscalers, most of them are spending all their free cash flow on AI related spending. And on the other side of it, the beneficiaries, the chip companies, they've gone up so much that people are concerned, is like, is this rubber band stretched too far?
Yeah.
And so I think there's a lot of digestion of that. I think what's also within that index sort of sideways action is a lot of software companies have gotten blown up over the last few months as they've been perceived to be at risk to AI. So there's a lot of things going on within the broader tech sector, and part of the role and the job that I have within that sector is trying to figure out who are the winners and losers.
And so ultimately, do you think that the same CapEx drivers from last year will continue into the end of the year? In other words, where do you stand on this particular trade? Will the NASDAQ 100 finish positive this year or not? That decides whether or not you're staying in or rotating out.
Yeah, I think it does end up positive. It doesn't mean that we can't have a tough couple of months over the summer as we're going to have earnings season soon.
Mhm.
And like I said, there's a lot of positioning problems within semiconductors as where like everybody's very overweight the space. So you could see some correction in the next, month, a few weeks to a month. But I think over the course of the rest of the year, I think it'll do well because I think this Capex spend trend and boom is going to continue into 2027. And when these hyperscalers announce their earnings, later in July, I think they're all going to reiterate their Capex intentions for 2027.
Well, I think you had predicted in April uh, that AI agents will shift towards AI, the future of AI will shift towards agentic AI and application layers. We're seeing that play out right now. So take a look at the CNBC article. AI agents will soon be able to match human traders, Robinhood CEO tells CNBC. That's a prediction, but he said the idea behind agentic trading is every capability a human can do will be available to an AI agent. I was doing programmatic trading as an institutional player before starting Robinhood, and what you don't realize is a large portion of traders are already automated and AI powered. Is he right?
That is correct. Yeah. I think short term that's probably a fair statement because I mean we're already seeing that now with algorithmic trading and systematic trading. I mean there's an element of quant powered trading behind daily, weekly, monthly trading already. So I don't think this is really a new statement by the CEO of Robinhood. And I think it's just expanding to what were typically just quant funds and other algorithmic funds to a broader pool of participants.
So ultimately, what in 10 years will differentiate a good human investor from an AI trader? We're going to go back to markets just a bit, but I'm curious. Let's say somebody graduates from finance in college and he's looking for a job on Wall Street, and the interviewer asks, "Why should we hire you over an AI bot?" What's the answer?
I think the answer is like I don't think machines beyond 1 year are going to be good at sort of analyzing companies and trends as humans are doing right now. I
Mm-hmm.
think very short term, you can't beat the machines. But long term, if you're a long term investor, if you like, I mean, I worked at a family office, the Johnson family office, for 15 and a half years before this role. We were investing for a very long period of time. Their capital was the duration of the capital was very, very long. So if you look at sort of anywhere between 12 months to 3 years, you can make some pretty thoughtful bets about where you see certain companies going and where you see certain trends going and take advantage of these corrections that overdo themselves on the downside to buy stocks at better opportunities. The thing with the machines, the problem is that there is a positive feedback loop.
Mm-hmm.
Once they start going up or down, it kind of feeds off of each other. There's no self-correcting mechanism. So corrections are sometimes sharper in a short amount of time than they would have done in a pre-machine world. But if you can step back and take a longer term view of how you want to invest, those short term freakouts are actually great opportunities to buy. It's just that in the moment they're very painful.
Okay, let's take a look at this slide from Hedgeye. Investment opportunity focus. Walk us through what we're looking at here. Companies with structural competitive advantages and identifying S curves and business model transformations, and how your framework or foundation, rather, sets the stage and lays the foundation for picking stocks.
Yeah, so the way I describe my strategies, I think about the holdings that I have in three categories. So the first one, as you see on the page, is like companies with, deep competitive moats with structural advantages that are durable over time. This is not like a new concept. I mean, every growth manager on the planet has something like this on their slide deck. So it's more the fact that what I wanted to say with this point is that once you identify a company that has durable competitive advantages, that's great. But you have to realize that nothing is permanent. Moats are not permanent things. So winners from like 10, 15 years ago have no right to continue to be winners in the next 10 years. They have to sustain that mode over time, and competition and disruption are forces that sometimes are not in these companies' control. So that's a very important part of understanding moats, is understanding the fact that nothing lasts forever. The second thing is, investing in S curves and disruption and trying to find investment cycles that are multi-year in duration. Obviously, AI right now is the biggest one, but throughout the last 20, 30 years, you could identify numerous investment cycles that were massive in scale that involves multiple industries. And if you do a lot of deep work understanding what those trends and those thematic concepts are, that can really get you a long ways for finding the companies that are going to be the winners versus the ones that are the losers.
Hmm.
And then the last category, it's just like is identifying, this is kind of more of a special situations category where you're thinking at businesses that are going through transformation, whether it's a new management team or they're breaking up or they're acquiring a new company or something very idiosyncratic, like something maybe geopolitically that's going on. Those changes can be sometimes really, really lucrative from an investment perspective because the market never knows how to really value those assets separately within a large company. So, if you are able to take a longer term view and really know and understand how these companies work and what the management teams are trying to do, you can do a better job valuing the long term sort of multiples of these companies than the market is at any given moment in time. So sometimes I've had a lot of success in that third bucket in my career because as much as, the sexy growth stuff is fine, but sometimes those breakup values and value creation opportunities are just as lucrative.
At what point, if you go to the companies in the top category here, Apple, Amazon, Alphabet, so on and so forth, at what point do you look at these companies as value stocks instead of growth stocks, in which case you have to completely change the comparables for the valuation metrics and say, look, we can't justify a PE based on other tech companies as a peer group. We have to use, I don't know, utilities or something as a peer group.
Well, if you look at the valuations of some of these companies, they've derated so much in the last year that, in one way you could argue that they're becoming value stocks. But I think that's not the right way to look at it. I think
Hmm.
that the most important factor when you analyze these companies, what's the growth rate and what is it going to be like in the next 3 to 5 years? And if you look at Amazon, Alphabet, less so Apple because it's not growing as fast as those two. They're still growing double digit in terms of revenue growth rate. So they clearly classify as growth companies. It's just that they're not the sort of incredible growth rates you're seeing in companies like Micron and SanDisk and SK Hynix in Korea. But that growth rate, as massive as it is right now, you have to think about how long is the cycle going to last? I mean, that
Yeah.
is the definition of cyclical growth, and people can make the case that it's no longer cyclical, but these industries have always been cyclical. It's just a matter of what that duration is.
Do you think as investors we spend too much time chasing innovation and figuring out who the next disruptor is, whether rather than just picking fundamentally solid companies with good business models? Let's take Apple for example. You mentioned Meta hasn't innovated anything since Facebook. What has Apple innovated in the last 10 years besides making new iPhone models every other 2 years, right? But their stock has done well and the company continues to churn out positive cash flow. So as an investor, ultimately, what should we focus on?
Yeah, I mean that's a fair criticism of Apple. The phone is
Yeah.
such an important part of their revenue base. But if you look at the watch and the AirPods, I mean they're not as big as a phone, but as separate categories, they're probably in the top 5 or 10 largest consumer electronics categories in the world. And so you could say that they innovated on those two things. But the way I think about Apple is the ecosystem, the iOS ecosystem. So whether
Hmm.
it's phones, obviously that's the most important thing. The watches, the iPads, the Macs. but also all the services that are attached to that. When you buy a phone or an Apple device, you are also buying a whole set of services that are attached to that, and those services are much higher margin than the hardware, and they're growing at a faster rate than the hardware business.
Yeah.
So if you look at the ecosystem of Apple, the whole iOS ecosystem, it's growing about maybe 5% a year. Think about the growth in the TAM in terms of the number of devices out there, and then the attach rate of each device in terms of how much each individual owns in terms of devices, but devices
Yeah.
and services. So, you got to think about Apple as much more of a platform company than a device company.
Yeah.
And when you think about that and how steep that moat is, and think about how, if you and I tried to switch from iOS to Android, how difficult that would be. That's, that sort of, buy-in,
Yes.
that lock-in is really, really a high bar.
Yeah.
And
Once you're in the ecosystem, it's hard to get out. You're right.
it's hard to get out as long as the ecosystem is user friendly and the software hardware integration is really seamless, then that's great. I think we're about to see in the next 3 years with Apple, we're going to get really surprised by the pace of innovation by this company, not just in iPhones, but also with AI related software features that are going to be part of what's going to drive a massive upgrade cycle in iPhones and other devices. And then beyond that, I think Apple is going to be a serious player in home robotics. And that is a
Mm.
while away, and there are a lot of companies vying for that. But these guys, given their brand and their integration with software and the user interface, is going to be a tremendously powerful player in a very new category that we are not even scratching the surface on.
Yeah, I do want to ask you about robotics as a theme, but let's just talk about Alphabet before we move on to that topic. Alphabet is a company I'm worried about, not just from an investment standpoint, but also because I'm a YouTuber and part of my revenues come from YouTube AdSense. And so the question is, how can Alphabet and Google, how can they maintain their average revenue per user, their ARPU, and maintain advertising revenues per user on a CPM basis when AI is eating up a lot of Google and just overall search engine traffic? People are replacing Google with ChatGPT. They've already done that. They're moving on to a lot of different other AI platforms and LLMs now. So is this an existential threat facing Alphabet? Are they the next Oracle?
Yeah, it's funny. It's a very good question. Like a year ago, I was very worried about Google precisely as what you described because of the search risk from AI. But I think after the DOJ ruling that ruled in their favor last August, that really allowed Google to sort of really push forward with their big initiatives, which is Gemini and their own model to offset some of the risks that were perceived there in search. So now, as everybody knows, if you go and search Google, the first answers you get are Gemini generated. So they've kind of started to disintermediate their legacy search business with Gemini generated content. As it relates to YouTube, YouTube is such an incredible asset. And it's because it's so hard to disrupt because it's user generated. You can create as much AI slop video as you want. OpenAI tried to do this with that app. I forgot the name, Sora. Sora is like, nobody talks about Sora anymore. So like I think, when it comes to human connections and interactions, there's something very valuable about humans creating content versus AI creating content. And I don't
Yeah.
think that's going to go away. So I think there's going to be a distinct difference between humans creating video and music versus AI creating video and music.
Let me just type in any search. All right, NASDAQ 100 news. Let's see. Okay, this one actually just, yeah. What is the NASDAQ 100? Okay, let's just see what comes up here. Yeah, I wonder, okay, so this AI overview at the top, is that cannibalizing their own ad revenues? Because it used to be, this spot used to be for sponsored posts,
Yeah.
right? I wonder if sponsors are unhappy about this development.
I'm sure they're not happy, but I think at the same time, what they lose on those blue lines below that they've historically monetized,
Yeah.
they're gaining on the AI overuse because you can still, link to certain things that are in that AI overview if you want more information.
Hmm.
And whatever real estate gets reduced below that on the blue lines, whatever is the top three or four or five are probably going to be more valuable than they were before because nobody's going beyond that first page. So
Okay.
those top, four or five blue links probably are more valuable. And within that AI overview, people don't go beyond that. That real estate in and of itself is valuable because you can click onto links there for more
Mm.
detail that direct you to certain pages which advertisers can monetize.
Yeah, I see. Yeah, it goes to a CBC link. All right, I'd like to shift gears now and talk about robotics. I mentioned that earlier. That hasn't been fully monetized yet by the consumer because we don't have humanoid robots in our homes just yet. What's the next step?
I think next step is going to be home related robotic electronics that interact with you. Um, we've kind of touched on this a little bit when we've had Alexa and Apple's HomePod, which wasn't as successful, where you could like use voice to instruct device to give you information or to book things or to take instructions. And then we're going to go several steps beyond that. And it's just a function of how powerful is a device going to be in terms of doing the task that you want it done, want it to get done, and two, what kind of form factor will it be? What will it look like? And I think we're still a ways away from having humanoids in your house. I think there's going to you're going to have to go through a lot of testing and just people's discomfort with having a robot in the house. I think that's going to take a while. But there are other sort of forms of robotics, like Apple is working on a desktop or a kitchen top device with a screen on a swivel that moves with you wherever you are, and you can talk to, you can interact with, and obviously it's linked up with your iOS
Hmm.
profile, and you can do that with a phone, but now you can have a desktop device or even potentially a tabletop device that becomes a robotic extension of what you can access by typing or talking on a handheld device.
Okay. Let's now talk a little bit about the economy itself. So today we saw the employment numbers cool down a little bit from the previous print. So jobs creation, non-farm payrolls came out earlier today on Thursday. Increased by seasonally adjusted 57,000 for the month, slower than the downwardly revised 129,000 in May, and worse than the 115,000 Dow Jones consensus forecast. Worse by a lot. This cool down, is that, let's suppose this trend continues, and I know non-farm payrolls data is very noisy. It moves up and down monthly. But suppose we have a cooling labor market. Would that change your investment thesis for tech companies at all?
Yeah, I think the point you made there is really key. That this is a statistic that over many years has become less valuable. I mean, there are other sort of secondary numbers like initial claims and ADP data that gives you perhaps a better real time data set to follow. But to your point, like if it does sort of cool going forward, I don't think it changes the underlying growth themes that are driving the economy, which is reshoring, which is a massive investment theme that's affecting lots of industries within the economy. And then with regards to AI and the data center build out, I don't think a slowing of the jobs market really would affect that per se, because that sort of spending that's going towards multiple years worth of
Hmm.
investments in revenue expectations that go out well beyond, a year or even 2 years.
Would a slowing job market prompt you to be more bullish on bonds or allocate more to fixed income as the expectation for a Fed hike becomes smaller if the labor market cools? And so maybe bonds see a bid?
Yeah, I think that's a really good question. I think Hedgeye Macro, and you probably you've spoken to Keith McCullough in the past.
Hmm.
I think they have the best macro research on the street. They are
Hmm.
forecasting that bond yields have peaked with the inflation number that peaked, like that came out really hot last month. So they expect that inflation is going to cool off as we go through the rest of the year. That's going to bring down bond yields, which is going to be a positive for the underlying economy, because those high yields going back early this year were really, really problematic for anybody wanting to, take out any credit. And the mortgage, the housing market was hit really hard. So we're very positive on yield sensitive, rate sensitive industries like housing and to some extent financials, and bond yields coming down as inflation sort of cools off through the rest of the year, I think is going to be positive for the broader markets as a whole, not
Okay.
just tech.
Now, finishing off on AI, we had talked a lot about the legacy companies, the Big Mac 7. Let's talk about some of these companies that aren't even public yet. Anthropic, for example, the best AI at the end of 2026. That's a trade on Kalshi as well. The point I'm bringing up now to you, Sam, is if you look at AI from an engineering perspective, and you maybe even speak to engineers or people who actually use AI, and you look at the pace at which individual companies are developing, how does that change your allocation strategy? If you look at this particular trade, for example, everyone believes, let's say Anthropic is a dominant model for 2026. Would that make you more or less bullish on other tech companies in the space?
Yeah, to be honest with you, like the way I see these models progressing over the next few years, that ultimately they're going to get commoditized because they all the new models as they come out, they kind of leapfrog each other. Anthropic was the best model for a while. Then, OpenAI came out with this latest model, 5.5, and Codex,
Hmm.
and they became as good or even slightly better too. So I think those two companies are going to continue to innovate and get better, but they're all going to be pretty close to each other. So that's kind of why I say I think ultimately these LLMs will become commoditized. I think where there's going to be a huge boom in AI in the future is really what I call SLMs, or small language models or specialized language models, which are going to be mostly proprietary. Because if you go into a company, you pick any large Fortune 500 company, and all the data that's housed in that company, that's all proprietary data. Now, if a JP Morgan builds a model within JP Morgan that just processes and looks at all the data, the billions of transaction data in payments, or whatever in transfers of money from one place to another over multiple years, that's going to be specialized data proprietary to them. But they can build their own models internally just to look at different slices of the data that they have. So that information is going to be very, very valuable. But to build those models and to build the compute to power those models is, I think, a really big driver of future Capex spending and AI spending that goes beyond just these two big companies, Anthropic and OpenAI.
Okay, excellent. Thank you, Sam. Great update. Great market analysis. Where can we follow more of your work?
Yeah, you can follow me on X at Sam of America. And also, if you want more information about us at Hedgeye Asset Management, you can check us out at hedgeyeam.com.
Okay, excellent. Thank you, Sam. We'll put the links down below. So do make sure to follow Sam on his social media and Hedgeye at the links in the description down below. Speaking again soon, Sam. Take care for now.
Thanks, David. Nice chatting.
Thanks for watching. Don't forget to like and subscribe, and don't forget to use my code LIN when you sign up to Kalshi. New users who use my code can get $10 when you deposit $10. Link down below or scan the QR code here.